after the Fed with 30 minutes to go until the start of cash trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, investors cheer as Powell signals that a cut may come in September. Meanwhile, Meta's upbeat earnings also fueling this rally. Now, all eyes turn to Apple and Amazon, which report after the bell today. And from $25 billion to zero. Details on how Bill Ackman's IPO dream imploded in just a few weeks. But let's take a look at where markets are trading about 30 minutes until the cash trade opens. You can see green on the screen once again. S&P 500 futures up about 0.5%. Of course, we had a relatively dovish Powell yesterday. We also had some pretty solid earnings, which we'll get to in just a bit. But you can see that in the NASDAQ 100 as well. That index higher by about 0.5% as big tech roars back to life here, and relatively quiet in the bond market right now, but that's after a big rally, Sonali. You can see we're just about at 4% on the 10-year Treasury yield.
And speaking of rallies, we're watching shares of Meta and Nvidia both rising pre-market. Meta now up more than 9% after revenue beat expectations, selling that AI story, Katie. Also, Meta in conjunction with Nvidia on the rise for another day. Gains of nearly 13% yesterday.
Yeah, it's pretty amazing that we had all that concern about CapEx, and still you see Meta really off to the races there. And pretty amazing to see NVIDIA follow through on that huge rally that we saw yesterday. Of course, adding a record amount of market cap. We'll see if that holds. But also a big focus, of course, on the Fed, because there will actually be two more CPI prints before that Fed meeting in September. And inflation keeps falling. Paul's Torsten Slok says that the Fed will have no choice but to cut rates.
Growth has actually been quite strong, whereas inflation has been coming down. So we have in the market and even the Fed been expecting that the economy would slow faster for the last 5-6 quarters. That hasn't happened. So that does raise the question, why should the economy be slowing faster over the next 2 quarters if it didn't happen over the last 5-6 quarters? So for the Fed, I do think that if we do get inflation still moving lower, they have now promised us that they will be cutting rates in September.
And of course, you'll remember that Torsten Slok was out with that big call that the Fed wouldn't cut at all in 2024, maybe changing his tone a little bit right now. But for more on the Fed's future, let's get to Michael Mckee. He is Bloomberg's chief international economics and policy correspondent, joining us from Washington. And Mike, you and I have talked about sort of when does the inflation worry shift to worries about growth. And it seems like the Fed is very aware of both parts of its mandate right now.
Yes, and as John Maynard Keynes apparently never said, but gets credit for, when the facts change, I change my mind. And that's what we're seeing a lot on Wall Street and around the world. Bank of England, the latest to move interest rates today. They cut by a 0.25 percentage point to 5%. And the question is, do they keep going? Because it was a 5-4 decision, very close. Bank of Japan, as you can see, raised interest rates. The Fed stood pat. But as you can see on that chart there, they are expected to start cutting aggressively, and the story may be in the labor market. That was what Jay Powell was talking about yesterday and asked about a lot. Do they have concerns about the labor market weakening too fast? And you see it in this morning's jobless claims numbers. 249,000 jobless claims, a big jump from 235 the week before. Now, July is always a month with seasonal issues, so we don't know if it's an actual trend. But as you can see, claims have been moving up for some time. Does it mean a weak payrolls report tomorrow? That's what everybody is going to be watching. The data ahead, as you mentioned, Katie, we get a couple of CPI prints and a PCE print and 2 jobs reports before the Fed next meets. And tomorrow's numbers expected to be 175,000 jobs created and 4.1% unemployment rate. But if we get a 0.1% rise in the unemployment rate, we trigger the SOM rule. If we get to 4.2%, which suggests that once you get to a certain level of unemployment, it accelerates rapidly. So the Fed may be indeed cutting in September, but the question is it because the economy has slowed significantly and we have problems in the labor market, and are they behind the curve, or is it because inflation just went away?
Michael Mckee in Washington, thank you for joining us. Of course, come back home. We have jobs to cover tomorrow. But joining us for now is Megan Horneman, CIO at Verdence Capital Advisors. And you see that labor market starting to show those signs of weakness. And you see the earnings picture and some signs of weakness as well in the consumer. Of course, those are backward-looking points. Megan, if you look at the forward look, compared to what you're seeing in the job market, how much more weakness follows through in that consumer story?
I think there's still some weakness to go for the consumer. If you look, they've been spending specifically on credit cards. Credit card debt's at a record high now. This is concerning given the fact that they just continue to spend and fuel this debt level that they have. So I think you're going to see the consumer pull back. We are seeing some weakness there in the labor market. We've seen mixed reports on consumer confidence. There's been some weakness shown there. So I think the consumer has some ways to go here. The other thing is if you look at, I keep mentioning credit card debt, but if you look at delinquencies, they're now rising pretty rapidly. So there's still some room, I think, for the consumer to weaken.
And I want to link together what we're seeing, of course, with the Fed and with earnings season. There was a great story on the terminal today that if you take a look at earnings calls, the words Federal Reserve on track to be mentioned about 380 times on second quarter earnings calls with analysts. That's would be the highest tally ever in records going back to 2001 if this pace holds. And I mean, when you think about that and you think about the health of corporate America right now, the health of the consumer, I mean, how badly do some of these big companies need and want a rate cut?
I think want is the word there of the day. These companies want it, investors want it. This is what I think we're seeing. I think there's a little bit of a difference on the need side of it, though. I do think the economy's slowing. I think the consumer's in trouble, but we're not collapsing. And this, collapse that everyone has expected has not occurred yet. So I think the Fed, that's why they're in this difficult situation, because inflation is slowing. It's not where they want it to be quite yet. The labor market, yes, it's weakening, but the absolute level of unemployment, the 4.1%, is still relatively low. Now, this morning's numbers that we got, and I know it's been mentioned that July has some seasonal effects in it, but when you look at the continuing claims that are at the highest level since 2021, that's something the Fed is going to take notice of as well.
Megan, if you take a look at the 3 cuts being priced in through swaps markets for Fed rate cuts, do you think the economy really needs those cuts right now?
No, not at all. I think if they do anything in September, again, the market's pricing it in fully for September. The Fed's kind of opened that door for that. But they've also made it very clear that there's a lot of information between now and that September meeting. We'll have 2 jobs reports, 2 inflation, more than 2 inflation reports that they'll get before we see that September meeting. So there's a lot of information between now and then. I think the most market-moving event we'll get will probably be at the end of this month when we get that Jackson Hole speech. That tends to bring a lot of volatility when the Fed speaks at that symposium. We'll probably get a little bit more idea then if September's a done deal. But I don't think that they have the flexibility, given that inflation, there's many areas of inflation that still are sticky, that they can come in with 3 rate cuts. I just don't see that possible.
Yeah, and it's a good point about Jackson Hole. They always tend to make news in the mountains, so definitely one to watch there. But let's talk a little bit more about earnings season. Of course, this was really the heart of earnings season, one of the busiest weeks out there. You think about what we've learned from big tech in particular. Do you think that this has sort of spelled the end of the rotation trade? Maybe we could still broaden out, but when it comes to leadership in this market, do you think that tech is in the driver's seat?
I think so for now, but I also think that the tech is also being driven by the fact that, as you mentioned, the market's pricing in 3 rate cuts. It's also being driven by the fact that we are sitting at that psychological 4% level on the 10-year, and we tend to see tech do well when interest rates move lower. I think there's a little bit of way too much optimism, I think, almost you could say price for perfection in the tech side. And I think that there is room for rotation that we saw on some of those small and mid-cap stocks, but the threat to small and mid-cap stocks right now is how slow the economy gets. If the economy slows much more than anticipated, then you will see, I think, some weakness there because they do tend to be cyclical.
All right, Megan, always great to speak with you. Appreciate you taking the time. That is Megan Horneman of Verdence Capital Advisors. Now let's take another check on futures right now because it looks like we're going to have another rally on our hands. You take a look at the S&P 500, up about 0.4% in the pre-market. Same too if you take a look at the Nasdaq 100, of about 0.3%. Not so great when it comes to the small caps. The Russell 2000 just about flat right now. But let's take a quick peek at some of the big names moving because that's where all the action is. In the single stocks right now, you can see Meta absolutely flying up 9% pre-market, of course, after their performance on the earnings stage last night. Different story for ARM, of course, sticking to that tepid sales forecast, weighing on shares right now, down about 11%. And Carvana actually turning a surprise profit, and you can see that surprise in the shares right now, up about 10%. We're going to get to all of it next. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. Russia is releasing Americans, Wall Street Journal reporter Evan Gershkovich, former U.S. Marine Paul Whelan, and the Russian-British dissident Vladimir Kara-Murza as part of a major prisoner swap with the United States. The two Americans have been jailed in Russia on espionage charges denied by them and the U.S., and in exchange, the U.S. and its allies will return prisoners to Russia that they hold under the deal. And the Israeli military said it had confirmed that Hamas military chief was killed in a strike in Gaza last month. The announcement that came after a day that Israel said that it had killed the group's political head in Tehran. And former President Donald Trump openly questions Vice President Kamala Harris's racial identity. Trump spoke at a contentious roundtable at the National Association of Black Journalists yesterday in an effort to reach out to voters of color. Harris condemned the comments, calling out the same old show of divisiveness and disrespect. Katie.
All right, and let's turn back to earnings right now because shares of Meta soaring in the pre-market, up about 9% at the moment. That's after the company reported a revenue beat as investments in AI help it sell more targeted ads. Bloomberg Intelligence senior tech analyst Mandeep Singh joins us now. And this was really the bar that these companies had to meet this earnings season, whether or not they could show that their spending was actually paying off. And in Meta's case, it seems like they actually met that bar.
And look, I think in the case of Meta, they are skewed to e-commerce, gaming, entertainment, these verticals. So it looks like the ad spending is really coming back very sharply for these type of companies. On the AI side, I mean, they are infusing AI across their family of apps. In fact, they called that WhatsApp adoption in the US exceeding 100 million daily active users. I mean, think of the revenue opportunity there, because that's the one app they have not monetized, even though it's got over 2 billion daily active users.
Does this give Meta more legway here to spend more on AI ultimately, given the payoff it's seeing across the multiple platforms?
Actually, that's what I was surprised by. They were quite prudent on their call about how they are going about CapEx. Remember, Microsoft said we are going to increase our CapEx every quarter going forward till the end of 2025. Meta actually underspent versus consensus in this quarter. They said, the lower end of the guide is raised by $2 billion, but they kept the upper end the same. In 2025, yes, they called out they will increase the CapEx, but they seem to be more in the wait-and-see mode as opposed to everyone saying we are GPU constrained and we need to spend more on CapEx.
Well, can we talk about Reality Labs? Of course, that's the division that's building those smart glasses and all their other exciting futuristic stuff. It lost nearly $4.5 billion in the quarter. That is a shocking amount of money. When does that start to narrow, or could it actually expand from here?
Well, one thing they've done, I think, this year is they have shifted some of that Reality Labs losses into AI. So even though it shows up as a loss for the segment, they're actually infusing AI in their Ray-Ban AR glasses. Now, you could argue, is it really AI spend that's showing up in that $4.5 billion loss? Or is it the R&D around the AR, VR? And I think there is a very fine line. You can't really distinguish what is AR, VR versus what is AI. And in this case, I think they have taken the actions to double down on AI, which is paying out. And remember, Meta owns its own large language model. Only 2 other companies have that. That's a big advantage. That's what Amazon doesn't have. That's what Apple doesn't have. And they have to rely on someone else to give them the large language model. So that's a huge plus for Meta.
benefit to open infrastructure. Mandeep, thank you so very much. That is Mandeep Singh of Bloomberg Intelligence, of course, in the middle of a very busy earnings season. We should also mention ARM, the company reporting earnings yesterday that were strong, but shares are under pressure after leaving its sales forecast unchanged. Don't miss ARM CEO Rene Haas on Bloomberg Technology today at 11 a.m. Eastern. And turning to the big earnings on deck today after the bell, the stakes are high for both Apple and Amazon. Investors are watching for more information on Apple's AI, iPhone, and AWS growth over at Amazon. We're going to discuss this with Maxim Group senior analyst Tom Forte. And you think about the potential over here at Amazon in particular. Curious about what you're more excited about given what you saw out of the rest of the group so far. Is it AWS potential with the cloud, or is it what you might see in advertising?
So what excites me most about Amazon is Andy Jassy's comments last quarter that the company today can both invest for the future and generate profits right now. So when you think about the investor focus for the June quarter, it's return on investment spend for artificial intelligence. And I think it's a very strong statement by Andy that Amazon can have high margin and cash flow today while investing for the future. So I think Amazon's well positioned as far as exploiting artificial intelligence to both drive incremental revenue and to improve its cost structure.
Well, talk to us too also about the investor focus, also specifically on the cloud, on AWS. Of course, we had Microsoft earlier in the week, feels like a long time ago at this point, but there was disappointment there when it came to Azure growth. I mean, what are you expecting to see out of the Amazon cloud unit in particular?
So I think last quarter, the trend was companies are starting to resume spending on IT and resume spending on cloud. And there had been a lot of efforts on focusing on expenses given the challenging macroeconomic environment. So I'm looking for that trend to continue in the June quarter. I do think that there's some risk to Amazon, as reflected in the Microsoft Azure numbers, that you may not see as robust a performance in its cloud computing division as companies in general are trying to determine if they're getting the proper return on their investment spend on AI. But I think that last quarter's trend on a resume of spending, less efforts on cost cutting by its customers should benefit Amazon in the June quarter.
Tom, you think about the spend that Amazon is making on newer initiatives. You think about the deal they struck with the NBA, for example. How do you expect them to address analysts about these initiatives and how it might pay off in the future?
So I've been doing a fun compare-contrast on Amazon's efforts to disrupt the sports broadcasters, the latest example being this NBA deal, and Temu's efforts to disrupt Amazon, the best example with the fact that they had 3 advertisements during the Super Bowl. So when I think about Amazon's spend for live sports broadcasting, I view it as kind of a lost leader. So to the extent they're disrupting the legacy players, I think that's the advantage for Amazon. But on an individual deal basis, Thursday Night Football for NFL and this potential deal with the NBA, I don't think they're making money as far as incremental Amazon Prime members or even from advertising revenue.
So big focus, of course, on what Amazon is spending money on and, of course, on that cloud. Let's also talk about Apple as well. There's a great story on the terminal today that the headline is Apple Amazon results are crucial for the NASDAQ 100's next leg. I think a lot of people would agree with that. And you write in your notes, actually, that investor expectations are too high for Apple right now. Walk us through that.
So think about shares trading at north of a 30 times multiple. And what would success look like on an AI-inspired upgrade cycle? Success would be, call it 5 to 10% EPS growth. So you're talking about a PE to growth ratio of 3 to 6 times. So, and by way of comparison, its big tech peers are trading more like 27.5 times forward PE. So I think investor expectations are way too high. If you look at the AI upgrade cycle for Apple, we think it can add 50 billion of incremental revenue, about half the benefit they got from 5G. The reason we think it's half the benefit is there's less pent-up demand. I don't think people waited to buy a next-gen iPhone that has AI capabilities. And then they have regulatory challenges when it comes to rolling out Apple Intelligence in Europe, which is 25% of sales, and China, which is 19% of sales. So I think right now, as it pertains to Apple, the stock's ahead of itself.
To that end, you've seen a lot of upset in some of the big tech earnings we've seen so far. And if you think about any areas of vulnerability, Tom, where are you most concerned?
So I'm absolutely looking forward to their comments on the September quarter and what they're saying about iPhone sales projections. What's particularly interesting, and I think Bloomberg broke the story first, is they're essentially going to ask consumers to buy the new hardware and then wait for a software upgrade to get Apple Intelligence. I can't think of a similar occasion like that for Apple in the past. But I'm going to be paying laser focus on the iPhone commentary for September sales by the company.
All right, Tom, really great to get that preview with you. Really appreciate you taking the time. That is Maxim Group Senior Analyst Tom Forte. And it's interesting, of course, his comments on that AI upgrade cycle. Remember, Steve Eisman, we interviewed him a couple weeks ago. That's one of the big reasons why he's bullish on Apple. Of course, it'll be interesting to see what the company reports after the bell. But coming up on this program, we're going to take a look at the companies making the most social buzz today next. This is Bloomberg. All right, this is Bloomberg Open Interest. A quick check on futures about 6 minutes until the bells ring. You can see still holding on to gains here, slipping a little bit, though. The S&P 500 about 0.3%, NASDAQ 100 up about 0.1%, and the Russell 2000 now nursing a loss in the pre-market, down about 0.2%. But it's time now for social climbers. The company's making waves on social media this morning. And first up, Moderna reducing its sales outlook for the year thanks to low uptake for its COVID shot in Europe. Pharma giant is trying to maintain its COVID vaccine business while also trying to find new uses for its mRNA technology. Next up, some bitter earnings news for Hershey. The chocolate maker reporting a second quarter miss as consumers spend less on candy and snacks. The company is also facing another batch of challenges, including the rising cost of commodities such as cocoa and butter. And finally, Weight Watchers is laying off employees and cutting costs as it struggles to stay relevant in the era of obesity treatments. Popularity of weight loss drugs from Eli Lilly and Novo Nordisk have really decimated demand for the company's iconic diet plans. Of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. And Sonali, this is really a recurring theme when it comes to the disruptive impact of those GLP-1s.
It certainly is. And you take a look at what we're seeing across the food industry right now, and you have to wonder, is this because of budgets, Katie, or is this because of those GLP drugs that people are changing their dynamics? You take a look, for example, at Wendy's. For example, they're still seeing the same EPS for this year, but they're cutting their sales guidance as their guest counts drop in the United States. So fewer burgers, but people who are spending money on burgers are spending more on them.
Yeah, I'm looking forward to discussing the impact of all that just in a little bit, of course, on this program. And coming up, actually, we're going to be speaking to iCapital's Anastasia Amoroso on how private credit is filling the lending gap left by retreating banks. That is right up Sonali's alley, and that is next. This is Bloomberg. All right, we are moments away from the start of the trading session. Of course, this is the first day of trading for August. And of course, it comes after what we saw, all the fireworks yesterday. Of course, you can see we have a little bit of a lift to futures right now in that trade after we got a relatively dovish Jerome Powell yesterday, sort of flinging the door open to a September rate cut. And of course, big tech earnings continue to roll on. And you can see the bells are ringing right now as we take a look, of course, at the NYSE, at the NASDAQ. And let's take a quick check on the major averages, of course, as trading kicks off in these first few seconds. And you can see, of course, the fireworks of yesterday not quite following through today. Of course, the S&P 500 up about just, let's see, 0.3%. The NASDAQ 100 just about flat, and the Russell 2000 pretty much flat as well. So let's get to the single stock action in the fast food industry in particular, because we have Wendy's and Shake Shack reporting. Wendy's cutting its guidance after a decrease in customers in the U.S. And meanwhile, Shake Shack, it's really soaring right now, or pretty much unchanged. We'll give it a moment. It's hoping to achieve positive free cash flow this year, Sonali.
Also keeping a look on the private asset world here, because two proxy stocks here, Apollo, Blue Owl, both in focus today. Apollo reporting an earnings miss. Profit is dropping at its Athene annuities business. Apollo now down almost 5% after more than 30% rally this year. Blue Owl down about 1.6% after a nearly 28% rally this year. We're also watching Meta, of course, surging after revenue beat and ARM slumping as it maintains a tepid annual forecast. Meta now up almost 9%. ARM now down more than 9%. We're going to take a closer look now with Bloomberg's Abigail Doolittle.
And to give great context, Sonali, for those earnings reports, let's take a look at the week in tech so far. And this has everything to do with NVIDIA. NVIDIA, after on Tuesday slumping to basically a 102 handle from its high, its all-time high on an adjusted basis of 140, now trying to rebound on the day off of the pre-market highs, up just about 0.5%. Lots of volatility here. And of course, there's a fear that they won't be able to continue to put up the big blowouts that they had, that at some point growth is going to slow. That is, in fact, modeled in. But again, on the week, a nice recovery for NVIDIA, which has been in a bear market, coming out of it now. Now, if we put the Meta and the ARM results into it, well, Meta having a great day, to your point, and they really put up a great quarter here. This is taking a look at the AI race overall. Meta putting up that big quarter, so they are in blue there. In white, we have ARM, because, of course, they put up a good quarter. They held the guidance, but investors wanted more given how much the stock was up on the year, at one point up nearly 140%. And then interestingly, there's NVIDIA in yellow. So in yellow, we have NVIDIA. In white, we have ARM. Those are more of the hardware AI makers. And then in blue, Facebook, or Meta, I should say, and purple, Tesla, which are more the shiny applications of AI. At some point, Katie, we're probably going to see it flip, where the hardware becomes more commoditized in years out. And then some of these applications of AI, those uses, they will climb. But right now, this is a look at the race, the AI race, and what it means for these stocks.
All right, Abigail Doolittle, thank you so much. And we should point out that Meta right now rising 10% at the open. That would add $123 billion in market value. So just some incredible numbers that we're seeing right now. Let's discuss all of it with Anastasia Amoroso. She is Chief Investment Strategist over at iCapital. And you think about sort of the mood music heading into this week. It was very tense. And now we have, of course, some of the big names finally out there. Of course, we still have some big ones after the bell today. But do you think we're past peak panic, or at least peak upset?
Well, I think we are for now, assuming Amazon and Apple deliver. But I don't know if we can assume that for both of those. But I do think the results from Meta are really encouraging to the market, because it really tells you that there are ways to monetize artificial intelligence investments right now. And what the markets were really panicked about is, we're spending all this money on AI CapEx, but is the payoff years away or not? And what Meta really shows is that the payoff is actually happening right here, right now. And that is very different from what we saw from other reports where, for example, Microsoft is clearly ramping up CapEx, but the revenue growth expectations are not ramping up as much. So yes, I do think that alleviates some of that concern, but I do agree with that leadership board for now. I think the semiconductors, the hardware stocks, I think their outperformance is likely to continue, because that's what investors are sure about right now, is that the other Max 7 stocks are going to be spending on CapEx.
So what does that look like now that we have a glimmer of hope from Meta? If you think that there's still some dry powder to put to work, do you still put it towards the Mag 7 names, or do you hold off until you see the rest of them catch up to the Meta story?
So now I actually sort of have a three-prong approach. Coming into last week, I would say it's a barbell of defensive stocks and also some of the rotation trades. And the reason we've liked that is because obviously the Fed is on the cusp of cutting interest rates, and I think investors are going to be focused on that. Defensives typically outperform after the rate cut. But the reason why I've now expanded this barbell into this, three-legged stool, and I'm adding semiconductors to things that you want to buy on a pullback. Look, I think within the big tech complex, there's going to be this divergence of who's immediately seeing the benefit of AI, who's not. But again, one thing that we can be sure of is that all of them are going to be spending on AI CapEx. And so semiconductors are the beneficiaries of that. They've pulled back nicely. So that's why I would be adding to that. And of course, it's a cyclical story as well, which will benefit from rate cuts.
So Matt Miller is off right now. He always likes to pull up these complicated terminal functions on screen. I'm going to do that right now, because if you take a look at NVIDIA and then the function SPLC, it shows that NVIDIA gets 19% of its revenue from Microsoft. So that CapEx spend is going directly to another big tech player, NVIDIA, and that's really propping up the whole market. And we spoke to Larry Adam from Raymond James a couple of weeks ago. I wonder how many times I'm going to bring up what he said, but he made the point that you want to go where businesses are spending money, not necessarily where consumers are right now. It seems like, again, you take a look at that very complicated function, that would prove that point.
That's right, absolutely. And if you look at the Microsoft CapEx numbers, I believe they're up something like 78% year over year. So that's a huge number. And so that's why investors are focusing on that certainty. But, the other point I would say, obviously the likes of NVIDIA are going to benefit, but not exclusively. That's not going to be the only player. And some of the headlines we saw this week is that maybe there's some competition that's heating up with other semiconductors as well. So that's why, I would look at buying a basket of semiconductor beneficiaries from AI.
Let's talk about not just what we're seeing out of earnings season, but what we're seeing in the changing expectations coming out of the Federal Reserve. You have a market now pricing in 3 rate cuts this year. Yeah. Do you think that this market needs those 3 rate cuts to materialize to keep the valuations we're at?
Near term, yes. I think so. And, of course, Fed Chair Powell did not say anything about the future path of policy. But I think part of the reason why some of these rotation trades have worked as well as they have is because markets are counting on the tangible benefit, the tangible relief from those 3 rate cuts. And if you look at a middle market company or a smaller company that maybe has had leverage that is floating rate, the fact that we have priced in those 3 rate cuts, that's providing immediate relief. Because if you look at the SOFR rates, of which some of those floating rate loans are based off, those SOFR rates 6 months out, they're already coming down. So I do think that if we see some pullback in those rate cuts expectations, the rotation trade maybe gives a little bit of it back. But longer term, I think the Fed and the markets are right to look for something like 150 basis points of rate cuts. And so that's what I'm looking for. And that's what I'm looking through is the actual relief that's likely to come.
And I want to talk about the rotation trade in the context of this very muted IPO market, because someone made the point to me sometime in the past few weeks that you think about the companies that are staying private, it's those smaller companies that might have gone into that small cap index. And now the companies that are going public are debuting as mid cap or large cap companies. Yeah. So you're not getting that quality in the small cap index. How do you think about that?
Well, this has been a trend that has been ongoing for probably 20 years. And if you look at sort of before the financial crisis or even further back, the average age of the IPO was about 8 years. Now the average age of the IPO is about 11 years, and that's being extended. And so what happens is when the companies, to your point, do IPO because they've seasoned so much in the private markets, they IPO at much higher valuations. But what this also means is that some of the hyper growth that typically is associated with a company that's an IPO, some of that hypergrowth has already happened in private markets. So that's why investors, I think, would be well served to look at both sides of public and private market balance sheet because a lot of the value can actually be created in private markets pre that IPO.
I want to pull up some of the stocks that we're looking at today here too, because Apollo, for example, KKR hit a record high yesterday. Apollo's on the decline today, but their fee-related earnings actually beat expectations. It was their spread-related earnings. So things are getting better for the private markets in some ways. How do investors get a piece of this? If you're a retail investor, you don't have a lot of options here. Is it just buying the stocks of the ones that are publicly traded? Well, the great news is that you do have many more options than you've had in the past. Of course, you can buy the stocks of some of the alternatives managers that we've discussed, but at the same time, what used to be an institutional asset class and where you needed to have a large ticket size for an individual trade, we are able to bring, as an industry, to bring down that minimum. We're able to expand access. We're able to expand reach to the retail investor. So it is actually increasingly more accessible in some of the traditional drawdown structures, but also semi-liquid structures as well. So I think access is there. But to your point, Sonali, I also really like the market opportunity right now as well. And I think you're absolutely right. Things are picking up for private markets. For example, on the iCapital platform, where we look at the private wealth channel flows into private market assets, we're seeing very strong demand for private credit, which represents about 44% of the flows that we're seeing on the platform. We are also seeing demand for private equity and infrastructure and secondaries. Those are all areas of strength. And when you think about the broader industry, the reason I really think there's a lot of momentum that's building, we are seeing fundraising pick up in year-over-year terms, especially in secondaries, especially in private equity, in direct lending. And we're also likely to see, Katie, to your point, a better exit environment with IPOs and M&A coming to the fore.
Anastasia, we have less than a minute left, but I want to go back to that point about access because it's interesting. If you take a look in the ETF world, and retail investors love ETFs, issuers from BlackRock to Goldman to Invesco are looking at ways to fit private assets into ETFs somehow. When you think about that structure, do you think that's a possibility?
Well, it might be a possibility, but I think a lot of work has to go into it. And I think there's a lot of industry appreciation for you can't just put an illiquid asset in a liquid format and call it a day. There's a lot of considerations that have to be given, and I truly believe that the industry is being thoughtful about that. I mean, to the point of access, of course, a private investor would prefer to have the liquidity, but you have to put really careful guardrails around that if you're dealing with private markets.
$20 says Katie rather see a private equity ETF before a Solana ETF.
There you go.
That is
absolutely.
Anastasia Amoroso of iCapital. Let's stick with some more markets ahead. Busy earnings season. This is Bloomberg. This is Bloomberg Open Interest. A quick check on the stock market. Of course, we are seeing green on the screen today, and the S&P 500 rising now at a faster rate. Nearly 0.8% higher. NASDAQ 100 rising in synchrony. The Russell 2000 getting a bigger bid at 0.3%. Katie.
And it's time now for top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo raising its recommendation on Carvana to overweight, also lifting its price target by nearly $100 after the online used car retailer delivered a surprise profit in the second quarter. Next up, we have Oppenheimer cutting Etsy to a perform rating after the e-commerce platform gave weaker third quarter guidance. The analyst says that the outlook suggests no near-term visibility. And finally, Loop Capital raising Reddit to a buy. Analysts say that there's upside to the street's estimates and cites an attractive valuation. Meanwhile, two stocks we're watching this morning post-earnings are Shake Shack and Wendy's. Shake Shack soaring right now at the open. It announced positive free cash flow for the first time in 7 years. Wendy's stock, it's also rising by not as much. That's after the CFO says that higher-end consumers are visiting more often. Michael Halen of Bloomberg Intelligence joins us now. Let's start with Shake Shack, because in the commercial break, you described the call as awesome. What actually happened?
Yeah, new CEO Rob Lynch has taken the helm. He authored a great turnaround at Papa John's, and it seems like he's got a great plan for Shake Shack, right? It's primarily going to center around improving the marketing program and increasing ad spend. You know, Shake Shack has not done a lot on that end, and he has a great marketing background, so we think he's the right guy for the job. And he's also talking a lot about running better restaurants, improving speed of service, right, improving throughput. And this isn't rocket science. You know, it's a difficult business to execute in, but it's not hard to figure out. Better food, better service, better marketing should help drive sales in the near and intermediate term for Shake Shack.
When you take a look at what was going on at Shake Shack and when you take a look at what was going on at Wendy's, what does it all tell you, Michael, about what it means to sell a burger in this market?
Yeah, so I would say, from a 5,000-foot view, this is really supports what we've been saying for a while, and it's that, the K-shaped recovery is impacting restaurant sales, right? And restaurants like Wendy's that cater to a higher percentage of low-income consumers, historically in quick service, about 30% of the customers are low-income consumers, right? And those consumers are struggling due to inflation, right? Due to higher restaurant prices and prices, frankly, everywhere, right? And so Wendy's has pretty large exposure to those customers, and they're struggling to drive positive same-store sales. Whereas Shake Shack caters to higher income consumers, and they're seeing less pressure to discount. They're able to continue to pass through larger price increases, right? And that's helping their same-store sales outperform right now.
Well, Michael, to that point, we did hear from the Wendy's CFO saying that higher income consumers are visiting more often. Maybe we aren't exactly seeing that yet in the earnings, but I think that says a lot about just the state of dining out right now in the U.S.
Yeah, from what we're hearing, everybody's trading down, right? From fine dining to lower cost full service, from full service down into fast casual down into QSR, right? It's kind of a cascade effect, right? And so if you're a Wendy's, your low income consumers actually drop out of restaurant visits completely to some degree and shop more at the grocery store. They are attracting some higher income consumers that are saying, maybe I'll eat out at a full service restaurant one or two fewer times a week, right, and save some money and go to a Wendy's, right? It's such a smaller portion of their customer base that it's not going to offset the traffic loss from the low-income consumers. On the bright side, they do spend more, and they do tend to buy higher margin products.
Michael Halen of Bloomberg Intelligence, we thank you so very much for keeping an eye all over the market for us. Now, coming up next, we're going to talk about Bill Ackman's IPO dreams cut short as he pulls the plug on the closed-end fund IPO. We're going to discuss it in today's Wall Street Beat. Stick with us. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a check on stocks. About 20 minutes into the first trading day of August, we have a rally on our hands. The S&P 500, the Nasdaq 100 up about 0.6%. Small caps getting in on the action, but to a lesser degree. The Russell 2000 Sonali currently up by about 0.2%.
Matt leaves the kids home alone and the party's on, Katie.
Yeah.
It's time now for today's Wall Street Beat. Bill Ackman pulling the plug on his IPO dream of that closed-end fund after his fundraising targets plummeted in just weeks. Joining us for more is Bloomberg's Bailey Lipschultz, who has been covering this top to bottom. And when I look at the story that was written overnight by Kathy Burton and Annie Massa of Bloomberg, one part stuck out to me, that Seth Klarman was angered that Ackman named him in a letter to big investors about the IPO that was later made public. This letter served as a role in complicating the IPO, didn't it? Is he losing friends over this?
I imagine his inbox is probably pretty filled with messages. I mean, when you look at kind of the pushback that we saw, according to the filing, that letter was never supposed to see the light of day, but he did name drop Seth Klarman's bow post. He did say that they were in for $150 million, name dropping them with Putnam and a teacher's retirement service down in Texas. But it does seem like shortly after that, bow post pulled its commitment, and then obviously things spiraled pretty quickly from there.
Absolutely. And you take a look at the press release that hit the wire yesterday. This question, they say, kept coming up. Would investors be better served waiting to invest in the aftermarket than in the IPO? Because I'm hoping you can translate this. So basically, this is a closed-end fund. Closed-end funds often trade at discounts.
Especially now, and he has an offering already in Europe that trades at a more than 20% discount. So from the start, when I was having conversations with people who actually operate at institutions who they were really trying to sell this to, in addition to the retail investors, why would you pay an equal amount knowing that it's going to trade at a discount when you also can, though the terms are structured differently, just buy already essentially the same asset?
You're going to get it on
20%.
sale in
exactly.
like 2 weeks.
So you need to find someone who's willing to put in billions of dollars, and typically closed-end funds cater to retail investors who maybe want to have someone like a Bill Ackman kind of help manage their retirement, and maybe they're not thinking that far in advance, but the institutions are not.
Part of this play, too, was not just the relationship with institutions, but of course his followers on X. Yeah. What does this mean for his relationship to all those followers?
Well, if you think about it, Sonali, 1.3 million followers is a lot for you and me, but it's really a small drop relative to the likes of an Elon Musk or a Donald Trump, who we see rallying millions and millions of followers. And when you do the math and just kind of break down what a $2 billion closed-end fund, which it was targeting at the end, you're still asking for north of about $20,000 a person on X. And a lot of these followers, maybe they're kind of falling for the tweets, or as he kind of framed it, part of his posse. Even if they're putting in $500 million, a lot of these people aren't seemingly going to line up to give 10,000 plus.
Well, apparently, again, according to the statement, they're reevaluating the structure. They're going to report back once they're ready to launch a revised transaction. I'm sure we'll be checking in with you again, maybe soon. That, of course, is Bloomberg's Bailey Lipschultz. It's time now for the trading diary. What you need to be watching this week, of course, big tech earnings continuing today. Earnings from Apple and Amazon after the bell, plus Intel after the bell later this afternoon. We're going to round out the week tomorrow with earnings from Exxon and Chevron. It's also big oil, in addition to big tech. Of course, also, we get the jobs report at 8:30 a.m. Eastern tomorrow. But coming up in the next hour, of course, on this show, really looking forward to a conversation with TMX Group CEO John McKenzie, of course, the parent of the Toronto Stock Exchange. That's coming up at 10:30 a.m. Eastern in our next hour. Don't go anywhere. This is Bloomberg Open Interest, and this is Bloomberg. 30 minutes into the U.S. trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, investors cheer as Powell signals a cut may come in September. And Meta's upbeat earnings also fueling the rally. Now all eyes turning over to Apple and Amazon, which report after the bell. And the view from Apollo. Private equity titan Jim Zelter says an industrial renaissance in AI and energy will spur demand for financing, Katie.
Meanwhile, we get a check on these markets. About 30 minutes after the cash open, you can see, again, we're still on rally territory here. The S&P 500 up about 0.5% right now. Big tech, a little bit more so, of course. We have some big earnings after the bell from Apple and Amazon, but right now we're up about 0.7%, of course, after we heard from Meta last night. Meanwhile, you take a look at the 10-year yield, currently down about 3-4 basis points on the 10-year Treasury. Sonali, of course, as we do get some breaking economic data.
Absolutely. ISM Manufacturing Index has fallen. Softer data once again, data just crossing the terminal. Let's get right to Michael Mckee, Bloomberg's Chief International Economics and Policy Correspondent. Mike.
Yeah, Sonali, the latest evidence that the economy is slowing and possibly slowing significantly. The ISM national number falls to 46.8 from 48.5. The forecast had been it would go up to 48.8. New orders crashed 47.4 from 49.3. And listen to this one. Employment 43.4 after 49.3. A big drop in employment, and that's going to have people maybe recalculating what they think is going to happen tomorrow with non-farm payrolls. Production 45.9 from 48.5. The bad news here is that prices paid goes up to 52.9 from 52.1. So bad news both on both sides of what we'd call the Fed's mandate.
All right, Mike Mckee in Washington. Appreciate the instant insight. Of course, you can see bonds rallying a bit in the aftermath of that. So let's broaden out now and turn back to markets because we're joined now by Greg Boutle. He is BNP Paribas head of equity and derivative strategy over in the U.S. Joining us on set. It's great to see you.
Likewise.
So we're going to get into the nuances, of course, but we have to start with your price target because for the S&P 500, your year-end forecast is 5150, which is relatively bearish. You take a look at where we're trading right now, about 5550. So tell us about the path that you see to getting to that number.
Yeah, I mean, when we set that price target back in February, it was actually on the upside of the market. I think the fact that we have this target on the downside is more a reflection that we don't think we should necessarily be chasing the market when it's at all-time highs than it is a very bearish conviction. What we've seen is a ton of rotation under the surface, and we think that's where investors should focus and being more tactical around markets rather than a big headline conviction index level move.
But what does rotation really mean to you at this point? You see the softening economic data. You wonder whether that bad news is good news because of potential rate cuts or whether more weaknesses in the economy will spill through to that stock market performance.
I think it's a great question. It's incredibly interesting. We think there's three things driving the rotation. One was how extreme positioning got ahead of earnings season, that narrow breadth rally that's been so talked about. The second thing is the macro picture and this idea that the first order reaction to weaker data is positive because the Fed are going to cut, but then does the data weaken too much? And then the third thing are the US elections, which are also a cross current for some of those rotational themes.
Tell us about the importance of positioning and flows right now because Scott Rubner over at Goldman has really been pounding the table that August typically is a terrible month for equity inflows. I mean, how are you thinking about all of those sort of technical factors as you weigh that with the fundamentals?
Well, I think it's quite good for explaining what has happened in the market because we came into this earnings season with the Magnificent Seven looking extremely overbought. We had a lot of leverage building in some of the more index products that are more focused on those large cap names. And we've seen a significant correction, and we think a lot of that is that washing out of positioning. At the same time, those names and parts of the market that have lagged, some of the lower quality, small parts of the market, you think Russell 2000, for example, were much less crowded. And as a result, we've seen this extreme rotation. So we think that that reflects a bit of a cleaning of that positioning. So we think a lot of what we've seen is maybe a bit of a healthy correction in something that got very extreme. And now we think it's a kind of cleaner place for the fundamentals to dictate the price action.
You've seen that rotation waver in recent days, especially when you see it in the small and mid caps. Do you believe that it's sustainable? Do you believe that those areas of the market can be protected if we see a further downturn?
They can, but I think there's an absolutely massive question there. So I think in the FOMC press conference that we saw yesterday, Powell was directly asked these questions about the two parts of the dual mandate. Clearly inflation has moved in a favorable way, but what does that mean for the labor market? We get the payrolls tomorrow, and the question is, at some point, is softer data going to manifest in something that's much more difficult for the cyclicals and lower quality? And those parts of the market look much more vulnerable than they did a month ago, given that the rally that we've seen. So we think it's something where, for investors who are thinking of hedging and looking at optionality, those are the parts of the market that we're most focused on.
Well, how do you hedge right now? I mean, do you just rotate into higher quality, maybe some of those less cyclical names? Or are you talking about, tapping the options market right now?
I think there's two things. So ahead of earnings season, we were very focused on suggesting people consider replacing pure delta views with optionality. That's worked pretty well through earnings season, but when we look at the options market now, it does look that volatility levels, the premium people pay, is more elevated. So we think people have to be a little bit more careful about how they use options now. I think in terms of portfolio construction, then I think you can look at blending things like cyclicality and quality. You don't just necessarily have to be at one end of the barbell where it's large cap, AI, or just the lowest quality, smallest companies. There's definitely a piece in the middle, think equal weight S&P, or blending quality and cyclicality as factors that I think can give you potentially better risk reward in terms of that balance.
I want to bring this conversation to the VIX really quickly, because the VIX, for so long, it was doing nothing. It looked like maybe we were going to get to single digits. Now we're trading with a 16 handle, which feels maybe a little bit more reflective of what we're actually seeing in the market. But how do you think about the VIX? Is there actually a useful signal that comes from this metric anymore?
Yeah, I think so, but you have to be careful what it is you're looking at. It's index level volatility. What we've seen is a lot more stock volatility. But if you have half of the S&P moving a lot higher, half moving a lot lower, the net result for the impact can be that it doesn't move a lot. So what we've seen, when the VIX got down to the lows ahead of earnings season, that was masking higher underlying volatility as a function of the very low correlation. So we think the risk of the VIX moving into a much higher volatility regime comes from correlation. So to see the VIX up in the 20s, what you really need to see is a risk-off move in which the small and mid-caps, the lower quality, and tech both participate together. I think in the short term, in a very tactical view, if the market continues to consolidate around here, then VIX with a 16 handle, it was a 12 handle just a month ago. I think we could trend back lower before we go higher.
Listen, there is a camp on Wall Street that believes we're headed lower before we go higher. And are you part of that camp? Do you believe that there's a greater pullback at bay, and is that what you keep your cash dry for?
I think what we've seen through earnings season is a pretty healthy correction and a cleaning out of some of the real excess in terms of positioning. I think for us to go lower from here, we need to see one or two things. Maybe some disappointments after the bell in terms of large cap earnings, and or a real deterioration in terms of the data. So that could come Friday in terms of the payrolls. I think absent either of those two things, I think the consolidation and the clean out we've seen kind of probably sets us up for a kind of short-term moderate rally. And we need to see a further deterioration in fundamentals, either macro or earnings, to take us lower.
I'm reading your notes right now, and you have this really interesting line that you should be careful what you wish for with softer data. It can become too soft, and it's interesting because it feels like we're still in this bad news is good news narrative when you think about what that means for the Fed, and I think that's an interesting pushback here.
Yeah, so I think we were at a point earlier this year where people were really fixated in seeing softer data. Now, clearly it was softer CPI was really what people wanted, and that has been delivered, and the market pricing for September, December, the rate cuts that we're now very, very likely to see has really firmed up. So if you think about weaker data helping from that perspective, well, there's less potential for it to move the needle there anymore. But at some point, if the data does decelerate too much, then it brings about the risk of a recession. And when we look at Fed cutting cycles, you can basically split them into two. Those where it's preemptive, you could think 2019 or the mid-90s where it's bullish for markets, and those where it is very bearish for markets because the Fed are cutting for a reason, which is the data is slowing too much.
Greg, we thank you so very much for your time. That is Greg Boutle of BNP Paribas. Now I want to pull up some breaking news here because you now have Fed swaps fully pricing in 3 interest rate cuts by year end. You pull up the WIRP function on the terminal, you see how drastically the swaps market has been moving alongside the data points that we've been seeing. The spot markets, of course, also moving quite meaningfully. You do have a 5 basis point drop in the 2-year yield today, and the 10-year down well below that 4% level, down now to 3.98. Of course, we had jobless claims this morning coming in much softer than expected, as well as that ISM data as well. Manufacturing looking like it's slowing, and of course the economy along with it. Now we're going to take a look back at those movers in the stock market. Here's Abigail Doolittle.
Well, let's take a look at one stock that is clearly working. It is moving to the upside. Meta Platforms up about nearly 10%, heading to its best day since February. They put up a great quarter. They had 7% bottom line growth, 2% top line growth, or beats, I should say. The growth, very significant. The growth on the bottom line closer to 34%, the top line growth of 22%. So big growth for Meta. They are spending tremendously on their AI infrastructure, but because of those results, investors looking past that spend. However, there's lots of earnings movers to the downside. Qualcomm down 5.6%. They beat, but the forecast is seen as a little bit of weak. There's some concerns around slowing mobile growth. ARM Holdings down 12%. They beat. They held the guidance, but because the stock was up so much, this is one of the chip companies that will have actual revenue attached to AI. Folks are waiting for the forecast to be boosted to account for that AI revenue. And then taking a look at the shares of Wayfair and Moderna, we have losses here too. Wayfair down 5.6%. They missed. Their third quarter outlook as trailing. Some are saying that the home furnishings decline is very similar or mirrors the great financial crisis. Stay tuned for more on that. And then Moderna down 15.3%, the worst day since 2021. They have cut their outlook on vaccine fatigue. Katie?
All right, Abigail Doolittle, thank you so much. And of course, you take a look at the bond market, too. Pretty interesting moves, as Sonali highlighted. Just to go back to that 10-year yield, breaking below 4%, of course, after we got that softer ISM manufacturing data, of course, after we got Jerome Powell yesterday, opening the door to a September rate cut. You can see rallying quite significantly when it comes to the bond market. On an intraday basis, looks like we haven't been below 4% since February, so some big moves there. Now, coming up, what to expect from tomorrow's payrolls number. We're going to get insight from Pooja Sriram. She is U.S. economist over at Barclays. That's next. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. Russia is releasing American Wall Street Journal Evan Gershkovich, former U.S. Marine Paul Whelan, and the Russian-British dissident Vladimir Kara-Murza as part of a major prisoner swap with the United States. The two Americans have been jailed in Russia on espionage charges denied by them and the United States. And in exchange, the U.S. and its allies will return prisoners to Russia that they hold under the deal. And the U.S. says the world should acknowledge that Venezuela's opposition won last weekend's election, while President Nicolás Maduro doubled down on his claims of victory. Venezuelans continue to protest the election, while the socialist president has intensified the rhetoric against his opposition. And in the race for the White House in the United States, Pennsylvania Governor Josh Shapiro met with Kamala Harris's representatives as part of the selection process for her running mate. Arizona Senator Mark Kelly's chances were dimmed as labor groups expressed opposition to his selection as the Democratic candidate's search for a running mate nears its end, Katie.
And of course, investors are weighing prospects of the Fed cutting interest rates in September as we count down to tomorrow's jobs report. Former Kansas City Fed President Esther George joined Bloomberg TV earlier today with her thoughts on the Fed's mandate.
We are looking at an economy that is growing, and by the reads of the second quarter, growing well above its sustainable long-run growth. You've got a strong labor market, and you still have elevated inflation. And I think that combination reminds me that the Fed's mandate is a long-run objective. And just as we saw earlier this year, the market had priced in a number of cuts only to have to pull back on that.
And that was Esther George, former Kansas City Fed president, speaking on Bloomberg TV earlier today. Let's get some more insight into the FOMC's thinking. We're going to do that with Pooja Sriram. She is Barclays' U.S. economist. And I want to bring you some of the market pricing right now because Fed swaps, fully pricing in 3 interest rate cuts by year end, Pooja. Do you think that that's warranted when you think about, of course, the state of the economy right now and what we heard from Jerome Powell yesterday?
Hey, thanks, and thanks for having me on the show. So look, to be honest, as a baseline, 3 rate cuts does seem a little excessive to us. Our own baseline is, we think they will have a window to cut twice this year. And, the totality of the data that they keep talking about are actually looking good. They're very consistent with this soft landing narrative that the FOMC has, one that they're trying to get to. So in that world where we have, gradual disinflation, labor markets cooling, but a welcome cooling, not a deterioration, and, still resilient economic activity, in that world, I think 3 rate cuts seems a little excessive.
Well, to that end as well, if you don't see those 3 rate cuts, how do you expect the economy to progress? There's a lot banking on the jobs data this week, but of course there are multiple inflation prints to look forward to as well. How does the Fed's job get trickier from here?
Oh, I think, they've made it very clear to us that it's a data-dependent Fed, not a data point-dependent Fed. And, I like to stress that point because I don't think it's likely that they get completely shook by any one data point unless, it's a really bad reading, say, on inflation or on the labor markets. So I think from now through the September meeting, we've got, 2 more inflation prints, we've got a couple more employment data, and I think eyes will be on all of those data, to be honest. They're going to be watching everything quite closely.
Well, let's talk a little bit more about the labor market. Of course, we get that jobs data at 8:30 a.m. Eastern tomorrow. And if you take a look at the statement that the Fed delivered yesterday, they basically said that they're attentive to both risks of its dual mandate right now. That, of course, is stable prices and full employment. You compare that to what we heard in June when the Fed was highly attentive to just inflation risk. So it seems like maybe there's a little bit of nervousness entering about the state of the U.S. labor market. What's your feeling right now, and whether we could see further weakening now that we're above 4% on the unemployment rate?
Now, that's a good point. And look, this shift in that statement happened, on 2 counts. One is the inflation data don't look all that bad anymore. After a very strong Q1, we've got Q2 inflation data looking far more benign and very encouraging. So I think that was one factor that helped the Fed sort of gain more confidence that the progress on inflation is moving in the right direction. And at the same time, we got this cooling in the labor market that a lot of us were waiting for and we weren't seeing, but that has happened. And so I think that sort of motivated this shift in language that you speak about, where they're saying, well, inflation, not so much a concern given the progress that we've seen, but yes, labor markets are cooling. So it makes sense for them to squarely shift their focus on both sides of the dual mandate. Now, going by, the data that we have so far, we think, things are cooling in a very disciplined manner so far, especially in the labor markets. It seems like demand and supply are rebalancing. We're not seeing any signs of an imminent deterioration, to your point. And of course, we'll see to tomorrow's report to see if that pans out.
What are your expectations for tomorrow's report, especially after you saw the jobless claims today, Pooja?
Yeah, so let me quickly talk about the jobless claims data. There's been a lot of focus on the claims moving up. And, while we take some of this at face value, we have, noted that there is a seasonality factor that seems to be distorting the claims data as well. So just, in today's morning's data as well, we think, the seasonality seems to have boosted the claims number, making it look a little more weaker than what the NSA numbers say. But that said, we agree claims data have been ticking higher. For tomorrow's report, we're looking for a 175,000 increase in total non-farm payrolls. That would be a touch slower than the number that we got in June. And we think private payrolls number should look a little better at about 150,000. It was at 136,000 last month. And one final point that I will make is, it lasts for the period that we're getting the data. We did have a hurricane that hit. Weather effects like these do tend to distort the data, so we need to take it with a pinch of salt.
Pooja, we got to leave it there. That is, of course, Pooja Sriram of Barclays, of course, and a very hot market for economic data right now, and a very swift movement in the bond market as well. Stick with us. This is Bloomberg.
we see a secular global industrial renaissance going on. And people talk about AI, but it's also in power, it's also in sustainable energy, it's in the auto sector as well. And when you look at the breadth of capital that's needed from these high quality companies, it really reckons back to what happened in the US in the 1920s and 30s in the build out of railroads and industrial America.
That's Apollo Asset Management. Jim Zelter speaking earlier on Bloomberg, of course, the co-president at the firm there. And I want to take a look here, Katie, at just how well these private asset stocks have been doing. Because you are seeing a little bit of a breather today, but these stocks have really been catching up here with the behemoth of Blackstone. And the firm's more heavily focused here on private credit in particular. Ares, Blue Owl, KKR have been rising this year at a much faster pace.
Yeah, it's really interesting to look at that chart, and it's pretty amazing. So you have KKR in orange there, really pulling away from the rest of the pack, and that only happened recently, really in July, I guess, after their earnings there. But it's really interesting to see Apollo sort of mid-pack here. I'm sure that's not exactly where they want to be.
Well, what's fascinating, what you're seeing, Apollo is the biggest of all the credit managers here, but KKR and Apollo are looking a little more similar now than they did before. Both of them now owning insurance companies. And interestingly enough, it's the insurance company profits today that fell below expectations. Fee-related earnings coming above expectations. That second part there is good news for the industry. It means the deal activity is coming back and perhaps profits along with them.
Absolutely, and it's an interesting point again on the insurance unit, sort of missing expectations there and dragging down the whole pie, at least on the headline level. So we'll continue to follow that, and coming up, we'll actually be speaking with the company behind the Toronto Stock Exchange, continuing to grow through acquisitions. John McKenzie, the TMX Group CEO, he joins us next. This is Bloomberg.
NASDAQ has been investing in moving all of our technology solutions into a cloud environment now for over 10 years. And that is really paying off, because by doing that, you're modernizing your data infrastructure, you're modernizing your architecture, and you're making it so that you can bring new technologies in faster, and you can play, I'd say, offense much more quickly.
And that, of course, was Adena Friedman. She is NASDAQ chair and CEO, speaking to us on this program last week. And Friedman really emphasizing the need for exchanges to grow and adapt to the latest technology for their clients. Let's keep that conversation going now with John McKenzie. He is the CEO of TMX Group, and he joins us in studio. It's great to welcome you to New York.
Thank you. It's nice to be here.
So when you think about the Canadian IPO market and the U.S. IPO market, I feel like we're dealing with similar issues here, and that's just that there haven't been a lot of IPOs. I mean, what is the view from up north about when that dynamic might finally change?
Yeah, and we often look to the U.S. to be the leader in terms of when the IPO market opens up. But I am seeing, and similar to the dialogue you had last week, really strong optimism in the market now for new financing. And we saw it in the last quarter, less so in the IPOs, but in companies going back and testing the market and raising new capital. So June alone was the largest month we had for capital raising on our two exchanges in the last 2 years. So that's a really healthy sign, because that means good deals get done, and that gives confidence to people that are looking to price an IPO for the first time. Even more importantly, we had a great announcement for an Australian-based mining company acquiring a Canadian company, so opening up the M&A market again. And they've already committed to list that on the TSX in the fall. And I'm always a big believer, you get a couple of really good transactions done with good execution, that gives the confidence for others to follow. We know from a pipeline standpoint that there are deals to come. There are deals to do. It's just a question of that market confidence.
Speaking of M&A, there's no secret here that TMX has been a very active acquirer as well in recent years. What does that mean for your future M&A ambitions? Do you think there's more dry powder left, and where would you like to expand?
Yeah, we really do. And we always focus it on M&A to accelerate the strategy we were already building. So we were building out a strategy in terms of getting deeper into data sets, indices, serving the clients that way, and deeper into the issuers, because we have over 3,000 listed issuers. So we're always looking at how we provide more services to them. So the two recent acquisitions we did, ATS Canada was a trust company that helps us serve issuers more, and Verify here in New York City, which is what brought me to New York this week, helps us serve that broader ETF and index community. So they're both accelerators, and we're in a position right now where our balance sheet is very strong. We've got a great track record on execution and investors that have confidence in what our team can do. That gives us the ability to do more. So we're constantly looking for new things that we can tuck in and scale up with the franchise.
Well, you went exactly where I want to go, and that is
Great.
straight to the ETF market, of course. I think you spent $1 billion in total on Verify, a transaction that definitely turned a lot of heads in the industry. So maybe just to set the scene here, what are you hoping to do with ETFs? Because I saw that and I was thinking, okay, they want to get more listings.
Yeah, and if I take a step back from that already, we're already one of the largest listers of ETFs in the world. We're actually over 1,000 listed ETFs in the Canadian market. And the Canadian market is only 2 to 3% of the global economy. So we've been way ahead of the game on that. We actually invented the ETF in Toronto over 30 years ago. A little known fact for everyone. We're the first market to do fixed income ETFs. We were the first market to do crypto ETFs. So it was an area that we thought we were going to really invest in so we could support our clients end to end. So not just on the listings, which we want to do more, but we also want to help ETF manufacturers create the next great new product. But we also want to be able to help them. And what Verify helps us do is create that ideation, but also help reach a larger investing audience, and also then do the analytics on the other side in terms of how their marketing and their outreach is performing. And when you think particularly as ETF manufacturers go to new marketplaces where they don't have their own distribution network, this is exactly what they need to get in front of a retail investing audience.
Right.
So we're already seeing fruits of the partnership we put together. We've got new products that are being launched in the Canadian market based on Verify indices. We've got new data sets that we're going to be bringing into Verify to create new product. And I'm really excited with what we can do together with the team.
Well, something I've been wondering about, of course, as we think about the IPO market versus the ETF market. I mean, new ETF launches are at record levels, and they have been for several years. You compare that to the IPO market, not too much going on, relatively speaking. How much of what's being lost in IPOs can be offset by new ETF listings, or is that not the right way to think about it?
I don't think it is, because I always think of ETFs in terms of what is the market for funds in terms of investing product. And at these days, I think we're seeing ETFs are only about a third of what you see in the mutual fund space. There's a lot of runway for growth, and a lot of runway for growth in developing in other markets. Like the European market isn't anywhere near as developed as the US and the Canadian market. So there's a lot of potential to keep growing ETFs. And at the same time, we're going to see listings come back. Now, even though the IPO market has been quiet, and maybe this is more unique to Canada because we have a junior venture market, we have a public listed venture market, we've still been bringing new companies to market even through this drought. Now, we've added 35 new corporate listings just this year alone, but a lot of them come through structured listings, direct listings, reverse takeovers, capital pool companies. So we've tried to build a lot of different vehicles to help a company go public, even if the IPO is not the right path for them.
Well, I promise I have just one more question on ETFs, and I'll be quiet for a while. But something I've been trying to contextualize is where does the ETF business fall in terms of the importance to the bottom line when you think about the regular business, the traditional business of exchanges? Because, of course, you think about what's going on in the U.S., and Stibo, for example, has been pretty aggressive saying, we want to beef up in ETFs. We actually want to steal listings from the other exchanges. But when you think holistically about the business of an exchange, how important actually are ETFs? How does that factor in?
I think they're extremely important. And I think when you look at an exchange like ours, which is different from some of the other ones you mentioned, we actually have the full end-to-end of the capital markets ecosystem. So not only are we working with the ETF issuer in terms of, again, distribution tools, creating the product, bringing it to market, but we're the lister, we're the trader, we can list options on it, we can put futures on it, we clear it, we settle it, we're the depository agent for it, we own our own trust company, so we can act as the agent to support the ETF issuer as well. So we can provide the full ecosystem to that, and it touches every part of our franchise. So in that way, it's critical.
The other thing Verify brought you to, as you mentioned, here to New York. And if you think about your ambitions outside of Toronto, how global do you want to get and how fast?
We set an objective a number of years ago that we wanted to be more global than local, so more than 50% of the revenue came out of, outside the Canadian market. We hit that in the first quarter of this year. So we're going to have to write a new objective for it now. The U.S. is a big part of that. Europe's a big part of that too. We've been growing the energy franchise in Europe. But in New York and the U.S. in general, we're doing a number of key things. So we're building out, obviously, on the index space, as we talked about. We're building out on the energy space. So we have a great business called Trayport out of London that we are working on building in New York to build that presence for energy traders, to give a better solution for the OTC market here. And we're working also on bringing a new actual equity marketplace to the U.S. as well. So we've got a team that started in New York that's working on a US ATS that's really focused on higher order, higher execution quality for buy side. We've already done this in the Canadian market. We launched 2 new markets last year to do it. So we're looking to port that into the US market to serve the client base here too.
I can understand the inclination to break into the US even more, but how much competition is there? I mean, we've seen a horde of new exchanges even start from scratch.
Texas.
Absolutely.
Yep.
And so what does it take to break in and ultimately succeed?
Not to be simple, but none of them are us. We bring a lot of capabilities to the marketplace that others don't, and we've been competing with large U.S. exchanges for years, either across border, where we've got the most seamless border of any capital market in the world, or directly in Canada, where CBOE and NASDAQ are already competing with us day to day. So we've got great technology, we've got connectivity already with the largest players in the industry, relationships, IP, trading capabilities. So we've got a lot to bring to bear that any other startup wouldn't have.
That was a nice mic drop. We're us, so that's how we're going to compete. I do want to go back to that deal you mentioned. Of course, Paladin, I hope I said that right. That's that Western Australia-based uranium producer buying Fission, and now they're going to list on your stock exchange. You said last week that more U.S. miners and other ASX-listed companies should follow their route to Toronto. How are you going to make that pitch? What does that look like?
We actually have resources directly in Australia that are doing this all the time. And one of the things that we can demonstrate is that, particularly in the resource sector, the bulk of the financing globally for resources gets done in Toronto, either on the TSX or the TSX Venture Exchange. We have over 1,100 mining companies listed on the 2 platforms, which also means we've got the biggest network of analysts, lawyers, geologists that all follow it. We're probably the only exchange that actually employs a geologist on site.
That's pretty cool.
That can actually assess these businesses. So we have the whole ecosystem. And so if you're a company listed anywhere else, and the ASX is a great market, but if they want to get access to North American capital, the best way to do that is to list in Toronto with that, again, seamless border between Canada and the US to access North American capital as an entry point here. We've got over 230 international companies that list with us. It actually makes us think either number 2 or number 3 in the world for international listings. And it's really based on that value proposition.
John, thank you so much for joining us in New York. It looks like we'll be seeing you here more. That is John McKenzie, CEO of TMX Group. We're going to get a check now on the markets with Bloomberg's Abigail Doolittle. Abby?
It's shaping up to be an interesting day, Sonali. If we take a look at the NASDAQ 100 futures, overnight basically higher and into the open up about 1%, a pretty solid gain. But on that worse than expected ISM manufacturing number, take a look at the leg lower. That's basically an intraday move of almost 1.5%. So bad news being seen as bad news. It's really especially interesting that we're seeing this decline given the fact that rates down so much on that print. Usually yields down would help out stocks, but today it's risk off. Stocks down, bonds up. Let's take a look at what's beneath the surface and really helping this decline move. And the stocks underperforming, down 3%. XLS Technologies down 11.2%. This chip company put up a weaker guide than expected. This is true too for Qualcomm, down 6%. And then take a look at NVIDIA. NVIDIA earlier had been higher, and of course lots of volatility here right now, down about 1%. Fears about whether or not their growth will be slowing. Right now it is modeled to slow in this current year and the next year. Still big growth, but the trend moving in the wrong direction for what's essentially a hardware company. Let's put this into the context of a new chart, because of course last week we were showing a chart that suggested that sub 100 could be ahead. This chart suggests the same deal. What we're looking at here at this point is a pretty ugly broadening formation, basically an ugly range of uncertainty. There is a possibility that we could see NVIDIA pop up toward the top around 130, but the bigger suggestion of this chart is to the downside. The RSI kind of trying to figure out what to do, momentum not really gaining. The reason that this stock really looks like it's likely to go lower, besides an uptrend that it could meet, not shown here. Take a look at this gap. This, of course, was on the last earnings report, where investors just very excited, very happy about the big beat and blowout guidance. Typically, though, these gaps tend to fill. That's closer to $90. So unless that quarter that they report at the end of this month, so we have many weeks to see yet, is of the same nature, there could be some more consolidation ahead for NVIDIA, that right now in an official correction and touch and go with the bear market, Katie.
A lot to look forward to when we do eventually get to those NVIDIA earnings in late August. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, a busy week for investors wraps up tomorrow with that jobs report. Up next, we'll hear from MIT economist Kristin Forbes. This is Bloomberg. Well, and MIT economist Kristin Forbes says that rates may not come down as much as expected. Forbes spoke with Wall Street Week host David Weston at the Aspen Economic Strategy Group's annual meeting.
There had been a leaning before the pandemic and the post-pandemic inflation to wait till you saw inflation, till you saw the whites of the eyes of inflation. And I think the lesson is learned. We need to allow central banks to be preemptive. They need to be able to start raising interest rates ahead of time when they think prices are going to pick up quickly. Related to that, I think an important lesson we've learned is that as economists, central bankers, we focus on inflation. So there's a lot of discussion now on how inflation is coming back. It's heading back to 2%. This has been a remarkably pain-free recovery, but it hasn't been pain-free. The price level has increased. It's more expensive for consumers to buy what they need to buy to keep their households afloat. And as economists, we forget that this price of a basket of goods matters to people. Things are more expensive. It's the price level that matters to people, not just the rate of change of prices. So I think we've learned an important lesson that the level of prices does matter. Even if inflation comes back down, the increase in inflation in the interim can be painful.
You're an economist, of course, not a politician, but I wonder what you just said. Well, that might help explain something that I find remarkable. The economy is quite strong in the United States right now, and yet a lot of people don't feel good about it. And we keep saying, well, inflation is coming down, we're getting under control, and it doesn't seem to be registering.
Yeah, and I think that's exactly why, is that as economists, we see inflation coming down, heading to 2%. They think everything's fine. If you look at actually where we are in this cycle, it's quite remarkable. We have had remarkable swings where unemployment increased. And now it's come back down. We saw GDP growth collapse, and now it's come back. So things look good in terms of the finish point. Inflation is coming down, too. But yet in the interim, we saw the price level increase, and everything just costs more. So even though the end point looks good, there's been a lot of pain to get there.
You've done research and analysis about the sort of rate cycles going back quite a ways. Was this one different from all the others?
Yeah. Great question. What's fascinating is when you look at this most recent rate cycle, there's some ways this is unique and unprecedented. There's other ways it's just like rate cycles from the 1980s and 1990s. I recently wrote a long paper on this for Sintra with a couple of co-authors at the World Bank, and we described this rate cycle as similar to the parable of the blind man and the elephant. I don't know if you've heard this one, but according to the parable, several blind men are told they're going to be introduced to a mysterious new beast. And each of them can only touch one part of this mysterious new beast, which is an elephant. And depending on which part they touch, they come up with completely different conclusions. You know, if you touch the trunk of an elephant, you think it's a snake. If you touch the leg, you think it's like a tree. If you touch the ear, you think it's like a fan. And similarly, when you look at this rate cycle, in some ways it's like nothing that's come before. In some ways it's a lot like past cycles. But let me give you a concrete example of some ways this is unique that we haven't seen before. One is just the swings in economic activity, the collapse in activity, the collapse in employment, and then also the rebound. We've never seen such a quick rebound in the labor market, in activity, and in inflation. Another way this cycle has been unique is that central banks, on average, across the advanced economies, were slow to respond to the pickup in inflation and recovery, but then they responded by being unusually aggressive to make up for being slow. So it's the most synchronized period of rate hikes we have ever had, at least in the data I've looked at since 1970. And it was also followed by central banks keeping rates on hold for longer, on average, than they ever have at their peaks. So unusually slow start, but then aggressive response, hold rates at their peaks for longer. And what's remarkable, despite all those unprecedented characteristics of the cycle, we're now settling about where you settle 2.5 to 3 years after you start hiking rates.
Well, I'm curious about that very point. There's a lot of debate about when the Fed is going to cut and how much they're going to cut and things like that. Maybe more important is where they end up, where it ends up, whenever that period of time is. And given your study of rate cycles, do you have a sense? Because some people think we're going to end up at a higher level than we were before, where you call it R-star, neutral rate, or whatever. Other people say, no, we're going to go back down to lower rates. Do you have a view on that?
So based on my study of historic rate cycles, what it suggests is rates may not go down as low as most people are expecting, or as, say, the Fed's dot plot is predicting. You know, based on this historical comparison, looks like things are largely normalizing now where you would at this point in a rate cycle, which means rates are probably settling not far off where they're going to settle. And rates now are about 5.25%. Which means they would not be going all the way down to the sort of 3, 2.25, 3.5 that is in the Fed's dot plot right now, given where all the other measures of economic activity are.
And that was Kristin Forbes, MIT professor of economics, speaking with Wall Street Week host David Weston. This is Bloomberg. All right, it's time now for the Trading Diary. What you need to be watching this week, which is just tomorrow. Big tech earnings continue today. We get earnings after the bell from Apple, along with Amazon and Intel after the bell this afternoon. Stock is down 40% year to date, so we'll see what they can deliver. Of course, we round out the week tomorrow with earnings from Exxon and Chevron. And of course, before we get there, the jobs report at 8:30 a.m. Eastern, Sonali.
And Katie, we're going to look ahead to those earnings after the close because investors are awaiting details on AI developments from Apple, Amazon, and Intel as Wall Street gets more hawkish about capex into new tech. Bloomberg Intelligence senior analyst Anurag Rana is with us now. And you think about the expectations for Amazon. What are you lining up for them?
Yeah, I think AWS growth is really critical for the momentum of the stock, which has done really well over the last 12 months. When we saw results from Google, we really thought that you will see good cloud results from both Microsoft and Amazon. When Microsoft reported, they basically got a good AI print in terms of AI contribution, but their non-AI cloud business decelerated a little bit. So that really puts a big question mark for what's going to happen with AWS going in tonight. We do expect some lift up because of AI, but guidance is going to be very, very important for them in order to maintain this momentum that they have.
Yes, so a lot of focus on the cloud when it comes to Amazon in particular. Let's talk a little bit about Apple, of course. We were speaking with Tom Forte a little bit earlier, and he made the point that you think about the AI upgrade cycle, he doesn't think it'll be as meaningful as maybe some of the other ones that we've seen.
Yeah, we are still very early in that. We haven't even seen them, launch the new phone with the capabilities. That's going to only happen sometime in the, September timeframe. So this is a seasonally weak quarter. You're not going to see major uplift over here. But I think China remains more important right now for the next 6 months than AI for Apple, because we saw a good relief rally when they reported good China numbers back in April. And we really need to see some commentary whether what's their position right now, whether they have been gaining market share or whether they are going to see a slowdown in China. So I think guidance from them on the China market is far more critical than anything else at this point.
At the end of the day, how much room is there for an upset? You think about how the other stocks have been reacting this season.
Yeah, I think, if they give a good, framework of growth in the next 6 to 12 months, and that's without the AI push. See, the question is not the AI push is going to come. It'll come for Apple, but the question is whether that's going to be over the next 12 months or 24 months. That's a big question. So, it's more a question of timing than the actual the refresh cycle. But I think China really drives the stock over the next 6 to 12 months.
All right, Anurag, really appreciate the preview. That is Bloomberg Intelligence senior analyst Anurag Rana. Meanwhile, we take a look at markets taking a bit of a dive right now. The S&P 500 giving back its gains, now down 0.5%, even more so. You take a look at big tech, currently off by about 0.7%. Of course, that's even with Meta's results yesterday. We'll see if we can change the narrative today when we get Apple and Amazon. And that bond market rally continuing. Now, coming up tomorrow on Open Interest, we have Rick Reeder of BlackRock, Savita Subramanian of Bank of America, and Acting Labor Secretary Julie Su. A lot to look forward to tomorrow. That does it for us. This is Bloomberg Open Interest, and this is Bloomberg.